The hidden long-term costs of Trump's trade war, what you need to know. Imagine waking up one morning to find that your daily cup of coffee has become a luxury you can no longer afford, or that the new dishwasher you've been eyeing is no longer available at your local store. This is the harsh reality that many Americans may soon face as a result of President Donald Trump's trade war. But here's the surprising part. Despite initial predictions of economic disaster, the American economy appears to be resilient, with the stock market recently hitting record highs and inflation remaining moderate. So where's the damage? The truth is, the largest costs of Trump's tariffs were never going to show up in the top-line economic data. Instead, they will be felt in the long run, as American consumers begin to notice a decline in the variety and quality of goods available to them. Consider inflation, which measures how rapidly prices rise over time. Inflation goes up when price growth accelerates and down when prices increase more slowly. Tariffs, though, are one-time price shocks. When a tariff is added, the prices of affected goods go up, but after that, prices don't keep rising just because the tariff is still there. The first bump might cause a brief spike in inflation, but it won't necessarily increase inflation in the long run, because tariffs don't change how fast prices rise over time. In the long run, tariffs don't hurt American consumers because they cause inflation or tank the stock market. They hurt because they make it harder for people to get the things they want. For example, imagine you're shopping for a dishwasher. Before the tariffs, you could choose between dozens of options at different price points. Buy cheap from China, pay a little more for a sturdy American machine, or splurge on a high-tech South Korean model. After tariffs, those foreign dishwashers might become harder to find, because American retailers might not be as eager to carry them on the shelf. If you previously wanted the fancy South Korean model, you would now have to settle for an American one. Tariffs reduce variety, and that makes American consumers worse off, even if domestic producers don't raise their prices at all. The costs are even greater for goods that don't have many American substitutes. Most coffee is imported, because the climate and terrain needed to grow it are scarce within the United States. So, when Trump's tariffs inevitably push foreign coffee producers to export their beans elsewhere, domestic coffee consumption will likely decline, and more Americans will probably start showing up to work bleary-eyed and grumpy. Tariffs might also reduce the quality of products that are made here, because they force companies to shift to worse supply chains. Suppose that the American refrigerator company had a long-standing agreement to buy its parts from a Mexican supplier. If that supplier then decides to stop selling to the United States, the American firm must negotiate a new contract with a different supplier, one that might sell parts that are either more expensive or that integrate less seamlessly with the rest of the refrigerator. Consumers would then get less bang for their buck. Even if the refrigerator costs the same as it did before, it would run louder, use more energy, and break more easily. The impact of tariffs isn't spread evenly either. Low-income households spend a larger share of their income on tradable goods, food, clothing, appliances, and so on, than wealthy households do, which makes them more exposed to the effects of import taxes. Plus, the basic goods that low-income households tend to buy are also sometimes taxed at a higher rate than the luxury goods more commonly purchased by the wealthy. For instance, recent trade data shows that imported men's suits face an average tariff of 18%, whereas suits made from artificial fibers are taxed at 41%. All this means that low-income families shoulder a disproportionately large share of the tariff burden, even though they're the least equipped to absorb it. Tariffs hurt households in the bottom tenth of the income distribution over 3 times more than households in the top tenth, according to estimates from the Budget Lab at Yale. But here's where it gets controversial. Some argue that the benefits of tariffs, such as protecting American jobs and industries, outweigh the costs. Others claim that the negative effects of tariffs are a necessary evil in the pursuit of a more balanced trade relationship with other countries. And this is the part most people miss. Tariffs quietly chip away at the economic freedoms that American consumers have, for so long taken for granted, to choose what they want to buy and to get good value for their money, unencumbered by state favoritism about where their goods come from. There might never be a single data point that shows exactly when or how things got worse. But, over time, the costs of Trump's trade policy will become clear. Fewer choices, lower quality, and higher costs that will strain the budgets of households that can least afford it. So, we have to ask, are the potential benefits of tariffs worth the cost to American consumers? Do the benefits of protecting American jobs and industries outweigh the negative effects on low-income households and the overall economy? We want to hear from you. Share your thoughts in the comments below. Economic impact of Trump's tariffs. Calm before the storm? As the deadline for Trump's tariffs approaches, experts foresee a looming economic tempest despite current tranquility. When President Donald Trump introduced his aggressive reciprocal tariffs on multiple countries in April, many economists predicted dire consequences for the global economy. Surprisingly, these forecasts haven't come to fruition. Yet, the U.S. economy, a powerhouse driving global growth, has shown resilience across various indicators. Inflation remains under control, employment levels are solid, consumer spending is robust, and the stock market has hit record highs. However, beneath this surface calm, economists warn of a potential storm brewing on the horizon. Many of America's trade partners, including allies like South Korea and Japan, face tariffs ranging from 25% to 40% unless they can negotiate favorable trade deals with the Trump administration by August 1st. But here's where it gets controversial. Some experts argue that the current economic stability might be misleading. Joseph Foudy, an economics professor at NYU's Stern School of Business, explains, once tariffs reach 20% or higher, companies may opt to halt imports altogether. This leads to delayed hiring, postponed investments, and a decline in economic activity. Even countries that manage to secure deals in time will likely face substantial increases in tariffs. For instance, the preliminary agreements with Vietnam and China, announced in May and early July, impose minimum tariffs of 20% and 30%, respectively. The European Union, the U.S.'s largest trading partner, is bracing for a proposed 15 to 20% tariff, with a 30% duty looming from August 1st if no deal is reached. Ursula von der Leyen, the president of the European Commission, has cautioned that a 30% tariff would disrupt essential transatlantic supply chains, harming businesses, consumers, and patients on both sides of the Atlantic. And this is the part most people miss. The uncertainty surrounding these trade policies can be as damaging as the tariffs themselves. Stephen Durloff, a professor of economics at the University of Chicago, emphasizes that even the limited tariff agreements reached so far represent significant shifts in U.S. trade policy. These changes will harm growth, even if they are less extreme than initially threatened, he notes. While the full impact of the tariffs hasn't been felt yet, many businesses stockpiled inventories to mitigate rising costs. Economists predict that the effects will become more pronounced. The effective average U.S. tariff rate is currently 16.6%, expected to rise to 20.6% by August 1st, according to the Budget Lab at Yale Department of Economics. BBVA research estimates that the current tariff levels could reduce global GDP by 0.5 percentage points in the short term and over 2 percentage points in the medium term. Bernard Heckman, director of global economics at the European University Institute, observes, it's too soon to see major price impacts in the U.S., but if tariffs reach the 20 to 30% range, the impact will be significant. Despite these warnings, Trump and his supporters dismissed the concerns, citing positive economic data. The fake news and the so-called experts were wrong again. Trump wrote on Truth Social, claiming that tariffs are boosting the economy. However, critics argue that the Council of Economic Advisors, CEA, report, which showed a 0.1% drop in imported goods prices from December to May, fails to account for stockpiling and covers too short a period to draw meaningful conclusions. Economists also point to warning signs in the data. Wells Fargo economists Tim Quinlan and Shannon Grain noted a 0.3% decline in discretionary service spending over the past year, a trend typically seen only during or after recessions. This is a critical point for debate. Does the current economic strength validate the Trump administration's policies? Or is it a false calm before a storm? Durloff suggests that the lack of immediate negative effects doesn't vindicate the administration's approach. There's a widespread belief that tariff threats won't materialize, and the effects take time to manifest. The absence of large economic impacts so far does not justify the administration's claims. What do you think? Are the tariffs a strategic move or a risky gamble?